recording, I'm going to be working through the costing mock exam, Sweet Treats Pty Limited. Please make sure that you have attempted this question under exam conditions before watching this recording. Alright guys, so because this is a 100-mark question, up front we have 30 minutes to work through the information provided in the scenario. Let's start. Sweet Treats Pty Limited is a manufacturer and wholesaler of confectionery. The company operates from two divisions situated on the same premises in Germiston, Gauteng. Budgets are prepared by senior management at the beginning of each year, and resources are allocated to divisions to ensure that profits for the year are maximized. Management deliberately sets targets that are difficult to achieve, and bonuses are paid to divisional managers if divisional operating profit margins exceed 40%. Both divisions use absorption costing. Alright, so if both divisions use absorption costing, remember that means that they include both fixed and variable manufacturing costs in the value of inventory. First, you're given information relating to the biscuit division. The biscuit division manufactures chocolate chip cookies, which are sold in 2 kilogram plastic bags. Alright, so 1 unit is equal to 2 kilograms. Inventory is valued at standard cost. Alright, so let's discuss this in a bit more detail. Guys, in terms of IAS 2, companies can either value inventory at actual cost or standard cost. If they choose to use actual cost, they'll either use the weighted average method to value their inventory or the first in, first out method, or often referred to as the FIFO method. So that's if they value their inventory at actual cost. They'll either use the FIFO method or the weighted average method. As an alternative, instead of valuing inventory at actual cost, they can value inventory at standard cost. However, there is a requirement that if they choose to value inventory at standard cost, the standards must approximate actuals. So obviously you can't be using old, outdated standards to value your inventory. You need to make sure that the standards are updated in light of current information so that the standard cost that you are valuing the inventory at approximates the actual cost. You are then given the standard direct material cost per unit is as follows. So we can see they have two different types of direct material, cookie dough and chocolate chips. For both of the direct materials, you've been given the cost per kilogram and you've also been given the unit cost. Then just below that, you've been told that 20% of material input is expected to be lost during the biscuit cutting process. Alright, so we have a loss in the production process. Now, it's important to note, guys, if this loss is expected, so in other words, the company knows that it's going to happen, they expect it to happen, it is a normal loss. And in terms of IAS 2, normal losses are included in the value of inventory. On the other hand, abnormal losses would mean that something went wrong in the production process. Abnormal losses are not expected to happen in the production process. And in terms of IAS 2, abnormal losses are not included in the value of inventory, but instead are expensed in the period incurred. Okay, so let's make sense of this information. First, let's have a look at cookie dough. We know according to the standard, cookie dough should cost 150 Rand per kilogram, and we have a unit cost of 225 Rand. So working backwards, we can take the unit cost. If we divide the unit cost by the cost per kilogram, that will give us the number of kilograms that they should be using in order to make 1 unit. So that gives me an answer of 1.5 kilograms. So according to the standard, they should use 1.5 kilograms of cookie dough to make 1 unit. All right, and the logic is as follows, guys. If they use 1.5 kilograms and the cost is 150 Rand per kilogram, 1.5 kilograms multiplied by 150 Rand per kilogram gives me a unit cost of 225 Rand. Let's do the same thing for the chocolate chips. For chocolate chips, according to the standard, they should cost 200 Rand per kilogram, and we have a unit cost of 200 Rand. So if we take the unit cost and we divide by the cost per kilogram, that's going to give us 1 kilogram. So according to the standard, they should use 1 kilogram of chocolate chips to produce 1 unit. And let's look at the logic again. It's 1 kilogram multiplied by 200 Rand per kilogram gives me a unit cost of 200 Rand. All right, so that is what they need to input into the production process in order to manufacture 1 unit. However, we know that there's a loss in the production process, that 20% of the material that they input is expected to be lost. So for both of the materials over here, 20% of what they input is going to be lost. So if they input 1.5 kilograms of cookie dough, they will only get 1.2 kilograms out the other side. And if they input 1 kilogram of chocolate chips, they will only get 0.8 kilograms out the other side. So let's just total this over here. In total, they input 2.5 kilograms of direct material. There's a 20% loss in the production process, so the output is going to be 2 kilograms. And that ties into what we were told above. We know that 1 unit is equal to 2 kilograms. The biscuit division budgeted to produce 200,000 units, and fixed overheads are budgeted at 24 million Rand. Chocolate chips are currently purchased from an external supplier. The candy division could manufacture chocolate chips. 1 kilogram of chocolate chips would require 1 kilogram of milk chocolate, 0.5 direct labor hours, and 1 machine hour. The chocolate chips would be packaged in 10 kilogram unbranded plastic bags, which cost 50 Rand each. All right, so currently the chocolate chips that they use in their production process are purchased from an external supplier. However, they could also be purchased from the candy division. You've then been given the actual results. During the year, the CEO of Sweet Treats appeared on a popular reality TV cooking show, resulting in favorable publicity and a significant increase in sales volumes. As a result, actual production volumes were significantly higher than budgeted. Sales volumes are expected to return to normal levels in the future. 420,000 kilograms of cookie dough were purchased for 60.9 million Rand, and 405,600 kilograms were issued into production. The supplier of cookie dough moved premises during the year and offered significant discounts in an attempt to sell all inventory on hand before the move. The supplier's new premises is 5 kilometers closer to Sweet Treats, and discounts like this are not expected again in the future. 380,000 kilograms of chocolate chips were purchased for 202 Rand per kilogram, and 374,400 kilograms were issued into production. Due to inflationary pressures, the cost of chocolate chips increased at a rate higher than management predicted when the standards were set. There were 5,000 completed units in closing inventory at the end of the period. The fixed overhead volume variance has been correctly calculated at 12 million Rand favorable. All right, so how do we calculate the fixed overhead volume variance? It's the difference between the budgeted fixed overhead and the absorbed fixed overhead. Next, you are given an extract from the financial records. So first, there are total expenses of 300 million Rand, and in note 1 you are told that total expenses include depreciation of 36 million rand, interest expense of 17 million rand, allocated head office costs amounting to 45 million rand, and research and development costs of 60 million rand. Accounting depreciation is considered appropriate to reflect the economic value of assets. Research and development costs relate to the development of a new product. The development expenditure did not meet the recognition criteria in terms of IAS 38, intangible assets. All right, so remember, if the development expenditure does not meet the recognition criteria, it can't be recognized as an asset on the statement of financial position, but instead will be expensed in the period incurred. And that's why it's included over here. The research and development costs of 60 million rand are included in the total expenses of 300 million rand. The expenditure is expected to generate profit in the current and next 2 financial years. All right, so that information relates to total expenses. Then you've also been given the operating profit margin, excluding allocated head office costs, which is 30%, non-current assets at book value, 480 million rand, and in note 2 we are told that the replacement cost of the non-current assets has been estimated at 560 million rand. There are non-current liabilities of 210 million rand, current assets of 68 million rand, and current liabilities of 44 million rand. All right, so that's all of the information relating to the biscuit division. Next, you are given information relating to the candy division. The candy division manufactures candy-coated chocolate balls, Brighties, and chocolate balls with a honeycomb center, Giggles. So just below you can see you have been given the total product cost for both of the products, for Brighties and for Giggles, and this is the cost per unit for each of the products. We can also see what goes into the calculation of the total product cost. There's milk chocolate, candy, honeycomb, packaging, variable conversion costs, and fixed conversion costs. All right, so what are conversion costs? Remember, guys, conversion costs are the cost to convert your direct material or your raw material into the finished product. So it's your direct labor costs and your manufacturing overhead costs. So instead of giving you the direct labor cost and the manufacturing overhead costs separately, instead I've given you the combined conversion cost. And you've also been given the annual demand for both products. The availability of milk chocolate is limited to 400,000 kilograms per annum. All right, so if milk chocolate is limited or restricted, that means we have a potential scarce resource. So that means the candy division might not be able to produce all of the products that they would like to produce because there might not be enough milk chocolate available. Both products are sold in branded 1 kilogram plastic bags. So 1 unit is equal to 1 kilogram. The Giggles packaging is slightly more expensive as it can be resealed after opening to maintain product freshness. So we can see that on the previous page. For Giggles, we have a packaging cost of 16 Rand per unit, whereas for Brighties, we have a packaging cost of 14 Rand per unit. Variable conversion costs are partly driven by the number of direct labor hours and partly by the number of machine hours. So we can also see that on the previous page. For variable conversion costs, we have 50 Rand per direct labor hour and 5 Rand per direct machine hour. So the variable conversion costs are partly driven by direct labor hours and partly by machine hours. Fixed conversion costs are allocated to products on the basis of machine hours. Normal capacity is 1 million machine hours. Included in fixed conversion costs is depreciation on factory plant and machinery of 7 million rand. Selling prices are calculated by adding a 20% markup on total product cost. Right, so on the previous page we were given the total product cost for each of the products. So if we want to calculate the selling price per unit for each of the products, we just need to add a markup of 20% to that total product cost. Fixed administrative and marketing expenses amount to 18 million rand, and selling costs are 5% of sales. The Candy division recently appointed a new accountant. One of his first tasks is to calculate the minimum number of Brighties and Giggles that need to be sold so that the division does not make a loss. Alright, so if he needs to calculate the minimum number of Brighties and Giggles that need to be sold so that the division does not make a loss, he needs to calculate the break-even point. He did not study this topic at university as he found the calculation extremely confusing if more than one product is sold. He's also unsure of which expenses to include in the calculation. He has, however, identified various weaknesses in the current budgeting process and suggested the use of EVA as an alternative performance management tool. We then have some additional information. The corporate tax rate is 28%, and tax authorities were in line with accounting in terms of allowances. The adjusted weighted average cost of capital for the biscuit division is 12%. All right, guys, so that's all of the information that you've been provided with in the scenario.